A collapse is coming that will shatter records and memories. Economists now quietly warn that 2026 will deliver a crash more devastating than both 1929 and 2008 combined. This time, three unstoppable forces are converging. Historic mountains of debt, aging populations eroding our economic foundation, and a financial system more fragile than ever before. If the last century's disasters were merely warnings, what will happen when every cycle breaks at once? Cycles in economics rarely align by accident, but the years ahead carry a dangerous overlap. Analysts tracking long-term trends point to the period from 2022 to 2027 as a window where multiple forces reach critical mass. The most watched signal, the yield curve, uninverted in September 2024. Historically, that single event has been followed by recession within 6 to 18 months, placing the highest risk squarely on the calendar from March 2025 to March 2026. Yet the calendar is only part of the story. Deeper patterns, some stretching back half a century, are converging as well. The Kondratiev wave, a cycle lasting 50 to 80 years, suggests the global economy is entering its harshest phase. Debt built up over decades, demographic shifts draining the workforce, and a looming wave of corporate bonds all come to a head in the same narrow time frame. In the United States alone, commercial real estate and corporate debt maturities peak at $1.5 trillion in the first half of 2026, far above typical years. Across Europe and Asia, similar maturity walls and workforce declines are visible on the horizon. Behind the data, the message is clear. Risk is not spread out, but concentrated. The 5-year window is not theory, but a reflection of hard numbers, debt schedules, refinancing calendars, and demographic charts all pointing to the same moment. With every passing month, the pressure builds. The question is not whether cycles will converge, but what happens when they do. The lessons of past collapses are written in the mechanics of how they unfolded. In 1929, unchecked speculation pushed stock prices far beyond any link to real profits. Margin debt, money borrowed to buy stocks, let ordinary investors leverage every dollar, magnifying both gains and losses. When prices finally broke, panic spread through a banking system that was fragmented and undercapitalized. There was no deposit insurance. As rumors of bank failures swirled, depositors rushed to pull their money out. One bank's collapse triggered the next. Within weeks, a wave of failures swept across the country, freezing credit and turning a stock market crash into a decade-long depression. Fast forward to 2008. This time, the bubble hid inside the plumbing of the global financial system. Mortgage-backed securities and complex derivatives disguised the true risk. Banks trusted each other's balance sheets until Lehman Brothers collapsed. Overnight, confidence vanished. Interbank lending froze as no one knew who might be next. The system seized in days, not weeks. Forced liquidations spiraled across asset classes. Central banks scrambled to inject liquidity, but the damage was done. Stock markets lost half their value. 10 million jobs disappeared in the United States alone. The speed of crisis has only accelerated. What took weeks in 1929 and days in 2008 can now unfold in hours. Automated trading, instant news, and tightly connected banks mean that a single spark can ignite a global firestorm. The banking system, once a slow-moving actor, now transmits shock at the speed of code. Each era brought its own vulnerabilities, but the core mechanics, leverage, trust, and the sudden loss of confidence remain unchanged. In the next crisis, these same forces may move faster than ever before. Global debt has reached levels that would have been unthinkable even a decade ago. Today, the total burden, sovereign, corporate, and household, stands at an all-time high relative to the size of the world economy. For corporations, the true test arrives in early 2026. That is when a wave of commercial real estate and corporate debt totaling $1.5 trillion comes due in the United States alone, dwarfing typical annual maturities. Across Europe and Asia, parallel maturity walls are stacked with hundreds of billions more. This is the refinancing cliff, an event not spread out over years but concentrated into just a few quarters. Most of this debt was issued when interest rates hovered near zero. Now, as those bonds mature, companies face a stark reset, refinancing at rates 2 to 3 times higher than their original coupons. For many, interest payments alone will swallow a growing share of revenue, squeezing margins and threatening credit ratings. The mechanics are simple. As the cost of debt rises, the ability to roll it over weakens. If funding dries up or even tightens briefly, a cascade of forced selling and defaults can begin in real time. The refinancing cliff is not a theory. It is a calendar event, locked in by contracts, and it stands as the most concrete trigger for systemic risk in 2026. In the world's largest economies, the share of people in their prime working years is slipping below 60%, a threshold not seen in generations. This isn't just a statistic, it's a constraint on everything from tax collection to economic growth. As the workforce shrinks, the number of retirees drawing benefits rises, accelerating the flow of money out of public pension funds. In Japan and much of Europe, 100 workers now support more than 50 non-working adults. In the United States, the Social Security Trust Fund is projected to begin running annual cash deficits before the end of the decade, even as the population over 65 grows by millions each year. Pension funds, once buffered by steady contributions and market gains, now face the prospect of more payouts than incoming cash. When asset values fall or contributions slow, these funds become forced sellers, liquidating stocks and bonds to meet obligations. This dynamic weakens the system's ability to absorb shocks. Fewer workers, more retirees, and rising longevity all combine to erode the fiscal cushion that once helped economies weather financial storms. The result is a world where policy options narrow and the ability to respond to crisis is diminished before the next shock even arrives. Beneath the surface of the financial system, an invisible network carries risks that traditional banks no longer contain. Non-bank financial intermediaries, hedge funds, private equity, money market funds now account for more than 40% of all global credit. These shadow banks operate outside the reach of central bank safety nets, linking markets through complex webs of off-balance sheet lending and opaque over-the-counter derivatives. The growth of over-the-counter derivatives has created chains of obligation that stretch across continents, connecting seemingly unrelated firms and assets. When one counterparty falters, losses can ripple outward through these hidden channels, bypassing the safeguards built after 2008. Supply chains add another layer of vulnerability. Key choke points, semiconductors, pharmaceuticals, rare earths, are concentrated in regions exposed to geopolitical risk. Disruption at a single node can halt production lines worldwide, triggering liquidity stress for companies up and down the chain. In 2026, the combination of shadow banking concentration and fragile supply links means that a shock in one corner of the system can travel quickly and unpredictably. With so much credit now flowing through unregulated platforms, the true scale of leverage remains unknown until stress arrives. The financial system has become a dense web where small sparks can leap from one strand to another, amplifying risk far beyond the initial source. This systemic fragility is the hidden fault line beneath the market, and it turns localized losses into global crises. A crisis unfolds not as a single event, but as a chain reaction that moves with relentless speed. It begins with a sudden crack, perhaps a missed payment or a spike in credit spreads. Within hours, liquidity dries up as lenders pull back and markets seize. Margin calls hit next, forcing investors to sell whatever they can, no matter the price. Automated trading systems, programmed to cut losses, dump assets in seconds, accelerating the fall. What took days in past crises now happens in minutes, as algorithms trigger wave after wave of selling. By the end of the first day, billions can vanish from the system, and banks start to question each other's solvency. In the days and weeks that follow, defaults spread, funding windows slam shut, and the real economy begins to feel the shock. Jobs, savings, and entire companies are swept up in the cascade. Professional risk monitors rely on a handful of quantifiable stress markers, metrics that move before headlines ever catch up. When the share of investment-grade bonds maturing in a single year climbs above 15%, refinancing risk becomes systemic, not isolated. Credit default swap spreads on major sovereigns and blue-chip corporates serve as the market's early warning siren, and a sustained move into the 200 to 500 basis points range signals broad credit stress and rising default risk. Forced sale volume tracked by spikes in mutual fund and insurance company liquidations is another critical gauge. When forced selling accelerates, liquidity dries up and prices disconnect from fundamentals. These checkpoints offer a toolkit for tracking the pressure points, numbers that shift in real time as conditions change, revealing stress long before it shows up in economic reports or market narratives. Every market cycle leaves a deeper mark. Today, global debt surpasses $300 trillion, and birth rates keep falling, pressures that no policy can instantly reverse. The next shock is not just possible, it is mathematically inevitable. In an age of fragile systems, the cost of denial grows with every day. Share your perspective below.